dollar strengthening incessantly.
According to the stats and prior experience, it is difficult to boost exports with a weaker economy. $1 has been worth more than 80 Indian rupees for over a month. The value of the rupee has more than halved since early 2008.
For the last 6 months, the rupee has depreciated 28 times by 34%.
Would a depreciation of the rupee boost exports and bolster India's economic development during the impending global slowdown? Let's find out. A country's exports primarily depend on two factors. First, customer sensitivity to the export price. This means that if demand for exports is highly price responsive, then a decrease in export prices raises export quantity more than proportionately, all else remaining the same. Export revenue, which is export quantity multiplied by price, therefore rises. If all other factors do not remain constant, especially if the export prices of competitors also decline, then the increase in our export demand and revenue, if any, would be less. Second, demand for exports depends on sensitivity to buyers' incomes, namely the income elasticity of exports, all else remaining the same. If the income elasticity of exports is less than 1, then a decline in buyers' incomes leads to a reduction in export demand, but not too much. In contrast, a decline in buyers' income would reduce export demand and therefore export revenue significantly if the income elasticity is greater than 1. Export prices and world income typically decline during an economic slump. During such periods, exporting nations profit whose exports are highly price responsive but less income sensitive. Additionally, when a currency depreciates, countries with lesser import content in their exports gain more. Increased reliance on imported inputs is unfavorable during depreciation because import costs rise as a result of depreciation. The cost of domestic inputs increases more quickly when domestic inflation is higher, which reduces export competitiveness. Thus, for exports, the real effective exchange rate, REER, is more significant than the nominal exchange rate. The REER is a trade-weighted exchange rate that takes into account domestic and international retail inflation and compares the currency of the exporting nation to a basket of other currencies. How do Indian exports fare on the above criteria? India's exports are more sensitive to income than to price, with an income elasticity of higher than 1. Therefore, any export benefit from currency depreciation is insignificant compared to a reduction in export demand brought on by a slowdown in the global economy. While the majority of Indian exports are price sensitive, over time their elasticity has decreased. As per the Reserve Bank of India's estimates, based on both 40 currency and 36 currency baskets, India's REER is steady, which means that there has been no significant export competitiveness gain in recent months as our rupee declined against the dollar. So what is the reason behind it? Well, first of all, Indian inflation may have been higher than that of trading partners, reducing the negative impact of the nominal depreciation of the rupee on price competitiveness. In fact, India's consumer price inflation for 2021 was high at 5.1% above the global norms for middle and high income countries, 2.5% and 4.1% respectively.
The performance of the Indian rupee is much better than its own peers.
From January to August 2022, the rupee depreciated against the dollar relative to the comparable months of 2021. The rupee, on the other hand, has continuously strengthened throughout the same time in comparison to other significant currencies such as the pound, yen and euro. The Indian rupee's fall versus the dollar has been partially offset by appreciation against other currencies, leaving the REER slightly changed. In addition, our exports, particularly those of manufactured goods, have a substantial import content. The two products that make up a quarter of India's total exports of goods, like petroleum, gems and jewelry, require the largest imports. The import density of a variety of other products has risen dramatically over time, with India's growing engagement in global value chains.
We're proactively deepening economic integration with trusted trading partners like India.
Apart from this, the estimates by the Organization for Economic Cooperation and Development show that the share of foreign value added to India's gross manufactured exports increased consistently from about 16% in 2000 to a peak of 36.5% in 2012. This declined to less than 30% by 2018, partly due to Indian hikes in average import tariff rates for inputs in recent years. Despite the recent decline, India's import intensity of exports remains high. Here it is crucial to talk about the Lerner symmetry theorem. The Lerner symmetry theorem states that when the value of the rupee declines or ad valorem import tariff rates increase, foreign inputs become more expensive, increasing the cost of production and serving as a tax on exports. Generally speaking, in a world where industrial processes rely on global supply chain networks, an export strategy focused on trade protection fails more than services. This has an impact on how competitively priced exports of manufactured goods are. The price of energy, a key production input that we import, is also likely to remain high for the foreseeable future. Also, supply chain disruptions and material shortages would likely continue on account of growing protectionism worldwide. Overall, it is unrealistic to expect that the rupee's depreciation against the dollar would provide a tailwind to India's export growth. Evidence from previous global downturns suggests the same. So this leaves us with one question. Is there a bright side? In other words, exports cannot be increased only by a weak rupee. If the goal is to increase export performance, we need to go beyond structural concerns and use a sectoral approach to strengthen competitiveness.